We're here with Carl Tannenbaum, Chief Economist of Northern Trust. Carl, great to see you.
Good to be with you.
So after a long period of low interest rates, they're marching higher. What's going on?
Prospects are that based on the incoming administration's policies, we could see more rapid economic growth. That usually will put pressure on all prices, but especially so when we are at or near full employment, wages being an important part of overall inflation and also the price of products. If we stress the labor market overtly, we're going to invite a little bit higher inflation.
So what is behind that concern about inflation?
Well, aside from the capacity that we have in the labor market, we have several other factors that may break the wrong way with inflation in the years ahead. Firstly, we've had a muted pace of healthcare cost increase over the last few years. That is now changing a little bit, and if we begin to relax some of the restrictions from the Affordable Care Act, healthcare costs could rise further. Oil prices are up. And if we close the borders or restrict them more to products and people, that will also tend to raise prices because imports have held costs down here in the United States.
If inflation starts to rise too fast, what's the role of the Federal Reserve?
Traditionally and importantly, over the last generation, it's been the Fed's role to lean against inflation when it threatens to get out of control. To that end, they've stated that they have a 2% inflation target, and while they'll allow inflation to run above that maybe by a little for a short period of time, if it ran a little hotter than that, they would be expected to respond a little bit more forcefully. I think the Fed's independence in pursuing that objective will be a very important thing to watch in the next year. Investors have come to count on their ability to check inflation, and if they lose that discipline, the markets will not perform very well.
Going back to higher rates, what are the consequences of a higher rate environment?
We're already beginning to see the impact it has on the housing industry. Mortgages, of course, are priced off of long-term interest rates, so borrowing is much more expensive. In addition, higher rates here in the United States can affect borrowing costs all over the world, and countries that are indebted and have borrowed in U.S. dollars are probably facing a little bit more of a challenge in repaying their debts as a result of the rising interest rate environment.
Are there any positives?
Well, certainly if you're a saver, you're getting better returns on your investments, and hopefully this will also serve to begin solving what is a very deep pension crisis here in the United States.
Carl, well, thanks very much.
Good to be with you.